Okay, today we're talking about taxes, and most of you are thinking this is a boring topic. And I gotta tell you, I'm nothing but boring, and I love talking about taxes. Why? Because when you are able to know the ins and outs of tax planning, you're able to maximize your income. And when you maximize your income, really good things happen. You're able to live more, you're able to give more. So today we're talking about taxes, and it's likely one of your biggest expenses that you will have throughout your entire life. So what are you doing to minimize your taxes both today and tomorrow? Well, I'll tell you this. The answer to that question that you need to learn is that the secret in minimizing your tax bill is all about balance. It's having the right balance between minimizing your taxable income today and minimizing your taxable income for tomorrow. So how do you do this? You do this by managing both your income and your investments. You got to look at both to maximize your wealth and to minimize your tax bill. So here's how I believe the best way for you to have this right balance between minimizing taxes today and minimizing your taxes tomorrow. First thing is to have approximately 30% of your investments in what I call non-qualified accounts. Non-qualified are non-IRA accounts. It's the brokerage accounts, your savings accounts that you have flexibility with and accessibility with. It's where you can get at your money prior to retirement. Now, when you put the money into a non-qualified account, how you invest your money is a different story because there's more lucrative investments from a taxation perspective. But when you put your money in a non-qualified account, you typically experience, for the most part, just capital gain tax versus ordinary income tax. Ordinary income tax is higher than capital gain tax. So I typically like to see about 30% of people's investable net worth in non-qualified assets. I like to see the next 40% of clients' investable assets in what I call tax-deferred accounts. Tax-deferred accounts are your 401ks and your IRAs, your retirement plans through work. This is where you're able to save tax money today because every dollar you put in there, it's not counted as taxable income in today's world, so you get to save that tax money today. All right, about 40% of your money should be in tax-deferred accounts. And then finally, the next 30 and the final 30% of your money should be in tax-free accounts. This is where you save money into a Roth IRA or municipal bonds, or sometimes it makes sense to invest in tax-free life insurance products. Sometimes it makes sense for that. And when you put money into these products, especially like your Roth 401k or a Roth IRA or municipal bonds, is that you're putting your money in after tax dollars. So you've already been taxed on that money. However, you're going to save tax dollars in the future because when you pull that money out to live on that money when you're retired, that money comes out tax-free. And I'll tell you, it's all about the balance. It's about 30% non-qualified, 40% tax-deferred, and 30% in tax-free investments. Because here's the deal. Working with clients over multiple years, many of my clients have just put in money into tax-deferred accounts, thinking that they'd be in a lower tax bracket in retirement. And needless to say, we found them paying more taxes in retirement. So it's about the right type of balance. So if you want to learn what the right type of balance is for yourself and your own investments and your own income, direct message me privately or come over to our private Facebook group entitled Building Worth and Wealth, where I'm going to give you all the tactics on how to minimize your tax bill and maximize your wealth.